Hey, hello everyone. This is Ram, CEO of Spurs. Welcome to the Marketplace Alternate Exit Strategy. We traditionally, I mean, this event's more about, this session is more about talking about different types of exit strategies that, other than the normal one. We know that there are normal exit strategies, the conventional exit strategies like an IPO, strategic acquisition, or a buyout, right? But we would want to really learn about, hey, is there a middle ground that we have? Is there a different path that we have in terms of exits that we could do, right? So to give us more about understand more about these alternate exit strategies, we have experienced panelists who've been there, done that, who would share their knowledge and ideas with us so that we could go and implement what it takes for us to get into this route. So let me take a quick second to welcome our panelist. Our first panelist is Mr. Chennappa Darapaneni, a serial entrepreneur and founder of Mera Events. Mera Events is an online event listing, promotions, and ticketing portal that revolutionized the Indian event industry. Currently, he is the co-founder of Dutch Uncles, an insightful and actionable resource platform for small business owners and first-generation entrepreneur to aspire, do, and succeed. He's an entrepreneur for more than 20 years and built many businesses in the US, Middle East, and India. His last exits are through alternative exit methods, so it's going to be great insights for us from him. My next panelist is Mr. Vamshi Reddy, co-founder, Apalia Technologies, founded in 2006, pioneering in video delivery on mobile networks in India. He's worked in the US for 9 years with Cisco mostly, decided to move back to India and start on his own, having built the company from ground up. Apalia currently employs 130 people in Hyderabad and serves customers across the globe. Over the decade, Vamshi has managed to win over major customers in India and abroad to make Apalia a leader in providing OTT solutions. He also raised investments from marquee investors like Cisco, Qualcomm, IDG, and Kalari. My next panelist is Mr. Hari Bharadwaj, CEO of Lera Technologies Inc., an IT firm helping banking and other industries in digital transformation with their innovative products and services based out of US and India, serving clients over last 17 years across the world. Prior to Lera, Hari founded a tech-based emergency and medical taxi startup and Uber for medical emergency transportation. Before becoming an entrepreneur, Hari held senior leadership roles with Amazon, Accenture. An IIMB graduate, Hari lives in Hyderabad with his family, and he's been Thai charter member over many years, helping and supporting startups ecosystem by supporting and mentoring many founders and startups. So let me take a moment to welcome all our panelists and they can say hi uh, to the to the audience. Hi everyone.
Hello.
Hi.
Hey guys.
Hi.
I do.
Hi. Hi everyone. Welcome. It's really great to have you guys on the panel. And I think it's going to be an even full session for us to learn from your experiences about the alternate exits. Prior to you guys coming in, I gave a brief. We all understand that there are a lot of, there are exit strategies, right? And there are very standard exit strategies like IPOs, a strategic acquisition, or a buyout, right? But then you see that there are only 2% of the startups who actually get into the success mode. I think there are 10% of the startups which doesn't survive at all, but there are 80-90% of the startups who keeps running the show, some means, right? And waiting either to close down or waiting to really get into a bigger exit, right? And sometimes I think we don't understand if there are any things which are which is a way out, right? Is there an alternate exit strategy that that people can adopt, which will really help them and not be in that mode of saying I have to either have this or that, right? So this question, I mean, you can, each of you should answer this. I'll start with Mr. Naidu to share his experience and what kinds of alternate exit strategies does he thinks that they are, and he's personally gone through, right? So Mr. Naidu, over to you.
Yeah, thanks, Ram. Thanks for having me here. See, over my 20 years of experience, I have got an opportunity to build two companies myself. The first one is being an IT company, and the second one is more of a product company for B2C customers. So let me, I mean, based on my understanding as an entrepreneur with all of us, right, we don't build companies only to exit at the starting approach, right? But at the same time, our thought process when we started a company and as these businesses keep building up, it changes a lot, right, in the process. So, but at the time when if you have raised the money in the process, obviously we all as an entrepreneurs need to understand that we have to give an exit to our investors or our stakeholders in the process, right? So keeping that in mind, right, it takes a good decent 5 to 10 years of time to build a good business to exit, right? So having that knowledge, in my first company, it took us almost 10 to 11 years in terms of building the business to a reasonable size of 100 plus employees, services company, growing good. And when I decided to pursue my next career, I was looking at, I had two things in my hand, right? I can't do manage two things, so I have to let it go one. So the first one which I've chosen is the strategic acquisition approach as the initial alternative exit method. There was a large another company called Aspire Systems. They were very good in strategic in product development company, but they did not have these implementation or service arm of the business. So we kind of approached them. It is a strategic expansion for the growth. Using the clients of us, they could able to grow further more. So ideally, the strategic investment is that based on your clients, what you own, the kind of revenue, what you're bringing on, the strategic company, how would they would able to grow further using that particular client list or basis, right? So that is one of the approach which I have chosen for my first company, which is the strategic acquisition, completely acquisition of the business, right? So that is the one which I opted in my first company. So the second one, which we all know, it could be acquisition. Sometimes it could be merger with another company. So that is the second process which I have followed in my second venture in terms of Mera Events, where when the business is profitable and it's growing up, but it's not enough to grow to the bigger level. So we kind of come together in the similar industry or similar product in the same business, came together, made a bigger company and tried to grow further. So that is where the strategic acquisition came into the picture as the second part of the business, So primarily so far, personally, I've experienced both strategic acquisition as well as strategic merger business in terms of the process, right? But having said that, some of the companies or other companies which I come to know about the acqui-hire, it's that completely they take the management of the things, not the entire company, the only the team or the knowledge or the product, and they just basically acquire the assets of the company. So that is something which we all keep hearing as acqui-hire or acquisition of the process, where they don't take the liability of the company, where they only acquire the entire the team and the product or the client's information only, right? So that could be another way of doing the alternative strategic acquisition, right? And sometimes we all as an entrepreneur, we think that okay, is the exit is the only strategy, because if there is no exit, there may be a time where there is no exit. We also need to think through that there's no exit and we might need to liquidate and move on, because a lot of entrepreneurs stuck with that I'm not able to exit, so they kind of wasting their energy and time in the same business years and years. So it is also okay to think no exit, I will liquidate my entire assets and then move on to the next level. So it is also one strategy which you can always think about it. So we'll come back on to once the other panel members speak. So hope that with the 4 acquisition alternative strategies I'm starting with here. Over to you, Ram.
Cool. Thanks for the insights. Now I want to ask Mr. Vamshi Reddy to talk about his journey and talk about these alternate exit strategies that he has in his mind.
Thanks, Ram, and thanks, Naidu. I think this was pretty good insights. Um, for me, I think there's several different options available depending on where you are in terms of your journey with your company itself. Okay, so I think the primary thing is where do you fit in the journey of your life cycle in terms of revenue, in terms of traction, in terms of growth of the company, in terms of who you have on board as investors. There's a lot of elements that come into play when you're defining an exit strategy, basically, right? So for example, just to give my example, basically we had like institutional and strategic investors on board, like Ram was mentioning. So they typically work on a fund life cycle, so you have to give them an exit in a predefined period, basically. So it can be 7 years or 10 years since their investments. So at that stage, you would look at different options which are available. Sometimes it might be as simple as doing a secondary sale to someone else and giving them an exit, or it might be doing a buyback and doing an exit for them. And again, talking specifically from a particular strategy standpoint. So those options are available. I mean, it really depends on where you are in terms of your business, how you're doing, and what you want to do with the business. So different options are available. So the one option you can always look at is, first thing is, if the business is profitable and they have been profitable and they are able to generate cash, right? Then the question is more about how do you actually figure out ways to actually, exit in terms of bringing the money back or paying the investors back. So in that case, you have options like, you can actually do a buyback, right? Because the buyback is a simple option where you can actually have like 25% of your free reserves, and the share capital. If you have that, you can actually do a buyback every year and take the investments back. That's one thing. You can always look at secondary sale coming in from a few people who might want to get out and few people who might want to get in. So that is one option where you can look at doing some secondary sale and all that. And of course, most of the times it's all about options for profitable businesses as such, where you're able to generate cash, you're able to do something with it. There's also options where we all know about if you're really at a scale which is say you're at a 30 million, 40 million dollar revenue kind of a stuff, doing decent EBITDAs, or maybe hardly there. Then there's alternative markets are there, like there's AIMS in London, which where you can go and do your listing, and no one stops you from doing that. There's not much criteria in what you do, but of course you need to get interest in investors on that platform as well. A great example is, I think, the recent one, which you look at IMI Mobile, which is from Hyderabad. They had got acquired by Cisco, so you will be knowing that IMI actually did AIMS, basically a listing. So they went to London and they listed in AIMS market. So it's an alternative market, which is a very, very interesting way in which you can go and list. The criteria is very low in terms of how you go and list yourself. Similarly, there is a alternative in India also for BSE SME listing. Again, you can use that. It's a very good what you call instrument which we can use because it doesn't put a lot of restrictions for that. Actually, if you use a BSE SME listing, the minimum size of the IPO can be as simple as 10 crore, basically, right? The market cap can be like somewhere around 25 crores. The only criteria being that you need to be profitable at least for 3 years, and you need to have some positive net worth of like a crore or something like that in past 3 years. So, but that has become a very, very standard mechanisms. I'm seeing a lot of people listing on BSE SME to actually do that. So that is one option you can always look at from in terms of exit. Um, and depending again, I think there's if you're like a really large company in terms, but you're not going anywhere. Say you're a company which is making like $100 million, and but the growth from there has been a little bit stagnant, or you're pretty much stable over there. You're not able to show much progress. Uh, there's this instruments, and they've been there for a while in US as well, called SPACs. Uh, and SPACs really are pretty good vehicles, basically, because and I see a lot of people going there. It's a special purpose acquisition company, and what they really allow you to do is, it's at a larger game again. You need to be somewhere in the 50, $60 million or $100 million kind of stuff. So these SPACs actually are companies which are going to be listed, but they actually have a blank check to go and look at companies which are in that range and accumulate all those companies and do a combined listing kind of a stuff. It's a very good methodology depending on where you are. Again, it's more for companies which are doing a little larger in terms of revenues. Um, I think that's those are the options. Of course, I always feel that there's thousands of options if you really want to exit. Then there's other interesting one is basically if you're really desperate, then there's companies which actually look at a lot of distress sales, and they pick it up. They can do 1x or 1.5x of your revenue multiple. Again, depends how the criteria works, but the simplest form is there's large corporations across the globe which are in billions of dollars, which actually look for smaller companies, consolidate, and give you an exit in less than a week, basically. So they just take over if it fits into a criteria, and then they have verticals to grow, and they'll bring in the team and they'll manage the team. So these are alternatives which are available in the global markets, as well as there's companies in India, like Altwist is a great example here, who actually can and does do that kind of a vehicle where if you have a great business model, reproducible, business model which can scale and has a lot of consolidation strategy, then they can actually acquire that company. But more of, you can think of it as a distress sale kind of stuff. So I would think those are the options typically you would have available to look at and explore, basically. So that's what I have.
Thanks, Vamshi, and I think some great insights. I'll summarize at the end after I hear from Mr. Hari. Mr. Hari, over to you in terms of what you think are some of the ways that are alternate exits.
Thank you, Ram. Thanks, Naidu and Vamshi, for your insights. I think both of them covered quite extensively in terms of the what could be the strategy, what could use, depending on the size of the organization, size of the startup you are running, and kind of market you are in as well, and also what kind of industry you are in, how the business is growing, and so on and so forth. But considering what Vamshi just mentioned, I think they are the kind of suggestions or ideas which could be greatly helpful to the companies who are established and doing a decent amount of revenues upwards of 10, 15 million dollars. But I would like to focus more on kind of a 10 to 20 million dollars kind of a downward under the that kind of evaluations, because that's where the most of our Indian ecosystem kind of startups are kind of being there. But just backing up a little bit, I've been before becoming an entrepreneur, I also been an intrapreneur, where some of the large organizations I used to work with, I used to be part of their M&A function, where I had an opportunity to be at the buyer side and looking at how the companies come to us in terms of why they want to get acquired, and what is that they're going to bring to the table, and what kind of situation they are in at this juncture for the larger company to buy them out, and what is the value proposition they are bringing to the larger organization, and in turn, and what is the value the joint organization is going to the end clients or end customers, right? So I had the opportunity to look at both the sides of it, and having said that, I had an experience. There are some companies, smaller to mid-sized companies, who go to large organizations, as Vamshi mentioned, kind of a distress sale. They tend to not to look themselves at the market. Where do they stand in the market from the value point of view, as well as what kind of a valuation they have, and as well as what kind of product and services they are in, how valuable they are to the buyer side. So the first step, in my opinion, is a company who a startup needs to be very close to the market in terms of what's happening around, what kind of valuations are going around, and keep an eyes and ears open, continuously in terms of understanding where do they stand vis-a-vis others in the same space or in a similar space, right? That's number one in my opinion. So we need to be very relevant. We need to be very careful watching the market in terms of what's going around, so that we become relevant and we will be very alert in terms of what one needs to do at an appropriate time, right? So these exits could come in many situations, right? One is when things are going absolutely right, where one would look at the conventional ways of getting exited, which is the getting acquired or going an IPO. IPO is a very thin chances at the moment because of the regulatory and other constraints coming in, and M&A is the best option as the things go at the moment. But most of the times we don't land up in a good basket, right? Having said that, so there are other alternatives one need to keep open, right? So if you ask me what are the other options or other opportunities we could explore, could be if things are going all right, then we need to look at is there an opportunity for me to in my network of people and startups or entrepreneurs, where someone could join me hands to scale it up for me or take it to the other markets, other geographies, or other and get a larger client base. Is there an opportunity for me like that? It's not necessarily an M&A, but it's kind of a joint effort between two individuals who have a similar interest as well. So it could be a friendly network of opportunity, exploring opportunities and mutual opportunities. That's one way of looking at it. The commercial modeling need to be worked out differently than normally what we do. And second thing is, if things are not going very well, or things are not going all right, then is there a way where we could look at, I've exhausted all my ideas, I've exhausted all my chances of running it the way it should have been. Then is there a way that we could bring in some new ideas by through different management, right? So where I take a back seat and then hand it over to somebody new, so who can bring in some amount of cash, at the same time some amount of newer thinking, newer ways of running businesses. Maybe I'll take a back seat, and at the same time I don't lose out all the control of the company, but somebody else is front ending the whole thing, and then it could work out as well, right? So then subsequently, once the things get better, then you could look at the options of handing over completely, and then diluting the stake or what have you. So that's another way of kind of looking at it, right? And third thing is about if there are similar kind of companies who wants to work with you, right? And there are the complementary products and services which you have, right? Is there a way we could to optimize the cost and optimize the resourcing costs and things like that? Is there a way we could work together to see how we could optimize and go to the market as well, right? So I'm talking very kind of a tangential kind of an ideas here, because Naidu and Vamshi covered most of the other ideas. So I'm thinking as an entrepreneur, as a founder, one needs to be extremely innovative and creative when it comes to how to run a company, and how to sustain it if at all we need to do it, and at the appropriate time. Okay, timing is essence here, right? That's why I said at the beginning, one needs to be extremely open to the market, and keep the networking going on, and do not be in a cocoon all the time saying that I'm running the company, I don't have anything else. So one needs to be absolutely open and keep interacting with others in the market, and then take the opportunity at the right time, and continue to talking to the key stakeholders, I mean employees to start with, then investors, and so on and so forth. Maybe we'll come to those topics later on. So that's something which I would like to really emphasize. Being gone through all their situations, and being an entrepreneur as well as an entrepreneur, that is something which I would like to lay out very clearly for the founders and entrepreneurs, right? Maybe we will cover the other topics later on, Ram.
Thanks, Hari. It was a good insight. So, in summary, I could see a lot of alternative exits. While there are some of them are overlapping, buyback of shares, alternate markets. change investor hands, strategic merger, or partnering together, combined listing, distress sales where you could get 1 to 1x of this thing. And probably, as a founder, once you see, you probably take a step back, get new blood in, and see, if this can grow together. All I think are great insights. So my next question, probably this is for
Ram,
Vamshi.
if I
Sorry.
may interrupt you, sorry, I just want to throw out one more point which I missed. Sorry about that. So another way of looking at it is, which I don't know if Naidu or Vamshi covered this, is that is there a way we could look at letting the company dilute on an installment basis? For example, I own 50% of the equity in a company, right? So if somebody, the investor comes in, some person comes in, say, okay, I'll let go 20% first. I bring in some cash into it and start running it, right? So is there a way I would kind of let control, give it to the new person on an installment basis, on a tranche wise, so that experience wise, how things are going can be realized much better. At the same time, returns to the investors also could be much better than normally letting go at once. Right? That's another way of looking at how do we structure that installment, or kind of letting the company go off in a part by part or a phased manner as well. I just want to let that out as well. Thank you.
Yeah, I think, I feel, Bharadwaj, that's a good insight actually, because most of the times you can also build a strategy where, you can look at a partial exit, which is secondary exit, and then lay it out for the next year, 2 years, because there's investments coming in and you can guarantee certain growth in the revenue for the next 2 years, so that the overall valuation is more of something which is better than what you have today, basically, right? Because you're achieving the target. So the guy who's buying it also gets excited because your skin is in the game as well. So, yeah, I see those kind of models also shaping up a lot. So there's 30-40% secondary sale happening in the initial instance. There's another 30 going in the first year, then another 30-40 going in the next year at a different valuation level. So that's actually a very what do you call? I see that a lot happening.
Good. Thank you, Amshi. Yeah. Ram, over to you.
All right, great. Thanks. I think very good insight there. Okay, so just before we get started, there's going to be a poll which will be open for all the audiences. Please do take these questions and provide your poll. Let's move on to the next question, which is primarily for, you can all speak, but we'll start with Vamshi. Generally, as a startup or an entrepreneur, you're in the middle of doing things, right? And sometimes you stop thinking about these things. So when do you start really looking at these alternate exits, right? What is a pivoting point for you? When I mean, what are some of the signals that you should see that, hey, these are the signals that has shown me, and which now I have to start looking at something else, right? That's when I have to make a decision. So any insights into what signals which will help them to say, okay, let's me start exploring these other options that I have?
I think it really depends on which stage you are, where you are. If it's a distress signal, then there is no option actually. Uh, but otherwise, I think it's mostly see, as an entrepreneur, I think the primary role of I keep saying this to every entrepreneur and CEO or founder, is that your job is to be on the lookout all the time, right? All the time. I mean, doesn't matter whether the market is good, whether the market is bad, where you are in terms of revenues, where you are in terms of growth or whatever it is. Every guy is always looking, doesn't matter at any level, right? Even a company which is at IPO level is looking at investors to take it to the next level. So there is exits and entries happening all the time. So it is a constant and continuation process. So you are looking out like Mr. Bharadwaj and Naidu were mentioning, within the circle, you are looking where the industry is, where are the companies that are strategically aligned with you, and you're talking to the people, you're knowing the ecosystem, you're seeing where you stand in the ecosystem, with your peers and companies, and start aligning in that direction so that you know where you are, right? And I think primary, those are strategically thinking. Every year, every moment you're thinking about that, so you are always building that strategy. But most of the times, um, it is about when you want to get an exit, then it's a different story, because then pretty much you are in a stage that, I want to go, which means you're fatigued. You want to move out of the business, or the business is going down, or you don't see that growth happening anymore. Then you are actually either doing it yourself, or you're getting a banker involved, or someone else involved to help you out with figuring out alternatives for you to sell the business.
Wonderful, great insights. Again, I'll summarize at the end. Over to you, Hari, and then we'll take Mr. Naidu's opinion.
Yeah, so the timing again, as Vamshi mentioned, it's very very I would say relative. A lot of variables involved in this in terms of when is the right time. So, and that's the reason I say one needs to be relevant, one needs to be connected to the market, and one needs to be talking to the investors and key stakeholders and employees regularly, and at the same time understanding where the particular firm or where the particular startup is going, and is there an opportunity for me to scale up, or do I see a growth in this sector, or I mean, see, it's a startup is a big exercise, right? And all of us know about it. It's a big every one 25th of the month, and founders heart starts beating heavily because of the payroll they need to run and things like that. So is there a way we could how long I can run if I don't get to where I wanted to, right? So one needs to be constantly looking at the financials, looking at the market, looking at the employee strength and how their satisfaction, can continue to keep talking to the clients, how happy they are. So there are a lot of variables involved in this, I mean, one should always look at the right opportunity, right time, and then move on, right? So there are a lot of times, why nine out of 10 startups fail is because of the founders' inability to get to the right time of exit. Even liquidating or closing down is not a bad option on some certain situations, right? But identifying that particular time, when is the right time for me to say thank you very much, I'm done, and telling everybody that I've done my best, and then let's move on types, right? So the lot of most so-called successful entrepreneurs, they've not been successful on the first one or second one. Maybe they've tried multiple times, maybe 10th 11th one they've been being successful, and then subsequently they become billionaires. So finding the right time to say, okay, I'm done, and this is the time I need to move on, is also extremely crucial. So a lot of variables, as I mentioned, and maybe complementing to what Vamshi said. So one needs to be keeping eyes and ears open and looking at the things very very closely.
Thanks, Hari. Over to you, Mr. Naidu.
Yeah. So speaking my experience, I think my first company I ran almost 13 years. At the same time, after 10 years, I said maybe it's a time to move on and do something new, right? And I was still continue to run the first company, but I started the second company while I was running the first company. So it came to a stage where I have to now only keep one baby. I can't keep both the babies. So that is where the time, we decided to let go one of the baby, right? So we said, okay, I'm going to exit this company and I'm going to continue to run this company. So that was my first initial experience. I decided, and then I've appointed an investment banker to let that go completely. So we found the right investor and moved on, right? So it's primarily two important factors. One is that the mindset of the entrepreneur, is he still passionate to run that business, or because now his priorities or focus is changed. Now is it important to get out? Because if priority and focus is not there as an entrepreneur, no business will actually go and scale it. So it is let it go and then move on to your primary focus of the business, right? So that is one factor which an entrepreneur look at it. Is still your priority and focus is there on this primary business? If not, I think it's a time to rethink about an alternative exit strategy, right? The second point is also the stage of the company and how the company is doing, right? Obviously, it's similar to a process, how you raise the funding process. It takes 6 to 9 months. Equally, the exit process is also takes 6 to 9 months or even sometimes longer. So you can't just like that, okay, tomorrow I want to exit, let's start it. No, it can't happen. So you need to plan the things in the way your funding process, however you spend the equal amount of time, you also need to spend strategically, plan well on the exit strat also. Like, who is your strategic investors? You don't just show that I'm ready to sell, right? You have to list out your customers, right customers, or who are the strategic partners. So you have to spend a decent amount of time and energy to exit also. So it is a stage, there's a mindset of the entrepreneur is one important, and obviously the stages of the business, right? And if you're in a bad shape, obviously you know that you won't get a better value. So it is always important, if you decided to exit, it is always exit when the things are in good shape, so that at least you get a maximum return of value in the process. Same thing, when you don't need money, you raise the funding, right? Similarly here, you're okay now, nothing will happen immediately, so it's time to exit. But if you're in a bad situation, because people, whoever is going to look at your books, right, if they see that it's not in a great shape, you definitely are not going to get the right value in the process. So it is important that when the things are in good shape, clean up your books, make sure everything is in right shape, make sure your statutory and all other things are in good shape. That is where you actually go and do it. So that is also another important lesson which I learned, because the company which acquired spent at least maybe 1/10 of or 1/5 of the money of the acquisition money only on due diligence. If your business is not in the right shape, your books are not maintained well, so it still comes to a challenge. So keep all that in mind and be ready, or maybe get an internal audit or an external audit before even you go into the market. So things like that. So it's the state of the business and the state of the entrepreneur what decides when is the right time to exit of it.
Another thing is, Ram, I mean, I think Naidu said it. So about the objective of the entrepreneur to start with, right? What is the key objective of startup or being an entrepreneur, right? So that need to be very, very clear. I mean, if you look at all of us are experienced in, running a pitch decks, right? And I mean, if you look at it, the last slide is about exit strategy, right? Or most of the investors would like to know what's your exit strategy. So the exit plan it will be there from day one, if you ask me that way, right? From the time you go for the first investment pitch, your exit slide is always there in that deck. So it starts from the journey starts from there. That means it says very, very clearly that one needs to be very vigilant about which is the right time, when to start, and when to kind of plug the button, both in good situations as well as not so good situations as well, right? If the things are going very, very well, then I think that's I mean, if the objective is to make money and not really build a large institution, then I think that's the right time. So it's all about objective of the entrepreneur and the founder and the investors, what they're looking for.
Cool. I think thanks, Hari. I think just to summarize again, I think you have to always keep on the lookout. There is no good time or right time. I think that's what is clearly coming out of it. The mindset and the priorities are very essential. Again, fatigue, having the same passion, and also stage of the company does matter in terms of how and when you should start looking at this thing. Good. That's great. I think the next question that again to Hari, I think Hari touched upon this about employees, customers looking at how the market is, right? So we do. I mean, when you're looking at these alternate exits, sometimes it's not a happy moment for the stakeholders, externally, especially your internal, external, and investors, right? Your internal could be your employees, external could be your customers, and your investors also. I mean, how do you really handle the communication, right? When you're saying, hey, probably we've anticipated to make a lot more money, we're not making money, or whatever it is, but we have to do this. Now, how do you really structure your communication? What would help so that your employees still are supportive, your customers are supportive about what it is, and how do you move forward with them, with this type of when you're starting to execute this type of strategy?
No, again, this is very important element of the whole process, right? So if you ask me what does it take? It's communication. So communication, right? And in the change management, communication is the most important thing, right? And we need to keep communicating, be very transparent, very open with the relevant stakeholders, both internal and external as well. And plus the clients. The clients are the guys who needs to be informed about these changes and what is it going to impact to them, good, bad, or ugly, right? They need to be informed. I mean, if you don't inform and suddenly you bring the change, and they will be really honored, and that's not good for the good. That's not definitely good. I mean, it'll bring in a lot of bad reputation. So for me, the most important thing is communication, and keep the channels open and be very transparent as much as one could. There are some things which we cannot completely divulge, but to a large extent, be open and transparent. And people do understand. People do understand, even in the good situations and not so good situations. People do understand. I mean, if you're exiting and then everybody else is making ton of money, I mean, that's a great situation. But having said that, even still in that situation, I would say communication and being open and transparent, and what are the impacts, is extremely important. So that is what I would say.
Ram, in
Over
our
to you. Yeah. Over to
uh,
you, Nayu. Yeah.
yes, there were certain things as an entrepreneur I was not able to do as when I was running my own company, right? As an individual founder, right? When I was exiting, I kind of ensured that, went back and see what is that something with this new thing I would like to negotiate as part of the deal itself, right? So we make sure that those terms and conditions were part of the deal in such a way that the things, the unfulfilled things, what you could not do for your employees, at least are taken care, and then ensure that the company is in a better shape. So that is something like you have to see. And when you're leaving, in the process also leaving your baby into a better hands, and that people has to remember for a long time. And I'm still happy and proud that it's been 7 years since my first company is taken over, and all the majority of the key employees are still there in that company, and much progressive way. And you will be more happy in that way in the process, and they're still thankful to you because their careers are grown much better. So one of the thing entrepreneur has to keep in mind is when you're leaving your baby to somebody, you need to really make in a better situation than what you could think of, right? I think that is the best what we all as an entrepreneurs has to think through. And obviously the communication is definitely, you can't be able to discuss everything before the deal is on the dot, because there are a lot of conditions in the process. But once it is done and the deal is done, you need to bring them and communicate it and share whatever the possible best thing and make everybody happy, right? The business will also succeed only if everybody is able to make money in the process. And these key stakeholders are important in the process, whether it's investors, whether it's employees. So it's a communication, once again, like as Hari mentioned. But you need to really make sure sincerely, you need to help the people what you could not able to do, and make that as a part of the deal. I think that will really make a win-win for all the parties.
Great. Vamshi, any insights into this?
No, I think both of you guys have covered it well. I think as a part of the exit strategy itself, consolidation and all that becomes a pretty normal thing. But you can always negotiate terms in terms of how long you want to keep your employees. Whether it's a year term or a year and a half term, there are terms which can be um, non-compete, non-solicit, which you need to look at very, very carefully, so that you are giving your employees enough options when the exit happens, because there's a lot of it comes with a lot of conditions. So taking in loop at least the key employees, making sure that they are communicated well enough, and like Naidu said, working a strategy where the key employees and are actually part of the new entity and feel home over there, I think can be negotiated when you're actually doing the deal.
Oh, great insights. I think great. I mean, just to summarize, we have another 7 minutes. I have one more question, which is very important. There is a question from audience that has come in, so I'll have to cover both of them. Communication, very important. Change management, again, any unfulfilled dreams that you committed to your employees, make sure that's part of the deal and communicate that to the employees. And probably what I heard is in the short run it could be painful, but once you make these exits and really think from an employee stakeholder perspective, after 6-7 years or 5 years, they all will be happy because their careers will be shaped up, and instead of really going down, you're actually taking up at some point of time. So great insight into that. I mean, actually, I'm going to skip one question, but I'll have one. I think Vamshi touched a bit about it in terms of what are some of the pitfalls or gotchas, or be careful in terms of when you're doing this, right? Sometimes you're in a situation where you want to do an exit, you could be exploited or something like that. So again, the question goes back to Mr. Naidu, is what are some of those, keenly careful things that you have to see in terms of, okay, this is somebody exploiting me, or what are the gotchas? So just your insights into this before I, we'll give 1 minute each so that I give 2 minutes last for the question that's been asked.
See, this is once again the state of the mind of an entrepreneur in the business state, right? Suppose you are in a bad situation in the process and you have to make this deal happen, right? But in spite of that, if you skip the process, if you don't follow certain verification of the process and systems, you still actually the result will be even worse than that. So irrespective of your situation, there are certain rules and regulations or the approach or a process one has to go through, like the way you raise money when you're going through exit also, like let's say you are merging with another company or thing, right? How to validate that information. Just you can't take on face value that okay, this information is right, so sometimes because you're in a desperate situation, you might tend to skip some one or two process that will make you a costlier affair in the later point of time. So eventually that the marriage or the relationship is not very fruitful for both the parties. So it's important either both the parties, whatever is agreed upon, go through that regular process and systems to ensure that it is as per the process. You can't hurry up on that process and skip it. It's okay to be transparent and open, but at the same time, you can't take any information at face value and then go on as assumption. Approach will never work on the merger process or any acquisition process or any alternative exit strategy. It is important to you do your background verification process and whatever needs to be done. Like any other good situation, you should do in a irrespective of whatever your situation is. So that is the most important aspect I personally feel.
Vamshi, your insights, quick insights.
I feel that I agree with Naidu. I think it's very important to make sure that you're looking this process at least when you're in a good shape, because but that you don't see a lot of visibility in the next 2 years. That's when you start the process, because otherwise you get into a distressed state and you'll have to take whatever you get. So if you can see the runway at least for 6 to 9 months, that's a better time to start your discussions so that you can get the terms at your own interests or whatever.
Mr. Hari, your point.
So quickly, when we're getting into this process, I think finding and identifying the right partners for you to take you through this process is extremely important. It's a jungle out there, all of us know, right? The competition is extremely hard, right? There'll be a lot of people who would like to hurt you. I mean, which is fine. That's how it is, right? So finding the right partners for you to take you through this process, who are reliable, who come through some references, and ensuring that they know what exactly you wanted to do. Being very open with them is extremely important. And once the process starts, I think there's no looking back, right? So in between, you can't change the partner or you can't change the process. So that's very, very important. Identifying the right partners with a relevant experience and knowing exactly what you're looking for, and that person understands what you're looking for. And second thing is about as Naidu mentioned, about being very vigilant about the processes required, being regulatory, being compliance related. So any of those things can really haunt you if they are not in good shape. And again, this is purely through my experience I'm telling. So one needs to be very thorough with that and ensure that before you even start the process, that clean up the whole thing, and to a large extent whatever possible, so that we don't fall flat later on, right? These are the two things I want to throw it out.
Great. I think that's great. So don't skip the process. Start early and find the right partner. Right. So that's the core of what we're talking about. Okay. So I am skipping one question in the interest of time. There's one question from audience. It is, I would also suggest that equity be diluted in trenches and also based on the commitments made by the investors. Would you agree on this? Right. So what's your, anybody can take this question.
Yeah, I think Bharatwaj earlier mentioned, I think you dilute your equity in tranches actually and create a plan for the next 2, 3 years where you're able to strategically work with them and create more value in the 2, 3 years so that you get a larger exit. That's actually a good model to go with. As long as you're willing to work with another company, it does have a lot of legal implications in terms of structuring and all that, but it's fairly used methodology basically.
Yeah, last thought on Hari from you,
Yeah, I think that's right. I mean, as I said, doing it phase-wise or doing in tranches makes a lot of sense for both the parties. At the same time, as a founder, as an entrepreneur, I need to be very well connected to the roots. I can't just let go easily. Though just because somebody else is managing or somebody else is at the driver's seat doesn't mean that I completely switch off. That doesn't work, right? So I think we need to be that works, that what very well works, that need to be commercially modeled very well and structured very well, and documentation need to be done very well, when and what happens. At the same time, connecting to the business, connecting to the new management, a new team is very important. Providing them right insights at the right time is extremely important.
Thanks. Any last minute thoughts from you, Mr. Naidu?
Yeah, basically, as an entrepreneur, you worked all your lifetime very hard in building the business, and struggled so much to build the business. At the same time, just by not doing the right exit at the last minute, you lose everything. So it's important that all the hard work, maybe you need to put equal importance, or the effort in understanding or acquiring the right knowledge, or even hire the right consultants or right people in making sure that you also exit very comfortably, and then make the last buck whatever the possible for you or your stakeholders. So you can't just because of your state of mind, don't let it go, because you worked so far hard work, you've done all the hard work done. But if you don't just learn this one except an important element, you lose everything, right? So it's important that there could be one class sometimes, or one important negotiation factor which you not thought through well. It is important utilize the right resources and make the best of use of your entire hard work what you have done as an entrepreneur.
All right, great. I think we are running out of time, and I'm getting reminders. But an amazing insights, personally to me. I think always keeping on the lookout. There is no right time. Be early. Always have a plan B, plan C types, right? So great insights. Thank you, Mr. Naidu, Mr. Vamshi, and Mr. Hari. Amazing insights into it, and I personally will cherish and learn from this. Hope the participants also get a lot of learning from this. Thank you, guys, and have a great day.
Yeah, good luck to all the Thai Global participants. Yeah, thank you.
Thank you.